Thank you, Rhythm. Rhythm, am I audible? I've just changed my audio source.
Yes.
So, thank you. Thank you, Rhythm. Uh, Good afternoon, everyone, and thank you for joining us this afternoon. It's a pleasure to welcome you today in the today's session on the key transfer pricing developments under the Income Tax Act 2025. Now, to talk about these changes, I have with me today two of my partners, Ashwath Pai from Bangalore and Harshit Mehta from Mumbai. They are both highly experienced international tax experts, and they regularly advise their clients in strategizing and structuring their business and investment decisions. Friends, as you are aware, uh, Harshit, can you put the slides up there? Friends, as you're aware, transfer pricing has been one of the most contentious subjects in the area of international taxation. Now, for multinational groups in India, it is often the single largest source of tax controversy and compliance effort. I remember the first assessment year was 2002, 2003. So we have already completed about 20, 22 years of audit. But unfortunately, the subject still continues to attract very significant controversy. Now, in the past, the regulators have proposed multiple changes to evaluate related party transactions from a risk perspective, from a procedural perspective. Uh, the changes in new law in the 2025 law deal with the so there are these are more or less they may look like procedural changes, but they have a much larger intent, a much larger impact. And this impact you will see on the reporting requirements. You will realize that the impacts are aiming to improve transparency. And obviously, it reiterates the need for timely documentation and precise documentation. So, in my view, these are developments that have the potential to influence how businesses will now identify, how the businesses will structure, document, and they will manage their cross-border transactions. Right from the point of inception, today there is the general tendency that there is a transaction that you do, related party transaction that you do. You look at it at the end of the year, you do your benchmarking. Sometimes you even delay the benchmarking. You have your reporting time when you do your reporting, and later complete your documentation and get done with it. I think with the changes that have been made this time, especially in the so-called Form 48, which was Form 3CB before, you will realize that today there is a need to take a decision on your benchmarking, on your methods, on all your business assumptions today, and document it in the most effective manner. Now, obviously, you cannot, with these new changes, you cannot expect transfer pricing to just be a simple compliance function. You obviously cannot do post facto changes. As a matter of fact, these post facto changes were never the intent. The intent was always to document it right at the point of inception. But again, these changes will now sort of necessitate that you document these changes right now. Uh, if you talk about the changes, I think one of the most significant changes is the expansion in the scope of the associated enterprises. As you know, associated enterprises is the very fundamental of the subject of transfer pricing. When there is a transaction between two associated enterprises, the transactions are subject to transfer pricing regulations. Now, what they've done is they have expanded the definition. So transactions that were earlier not covered within the perspective of related party transactions are today covered. Now, what is the reason now? Now, in the existing law, in the existing reporting requirements, what you need in order to establish a related party transaction is significant. Now, what this definition, expanded definition, has done is it has taken away that very element in the definition. So today, when you go back, look at all your relationships, your suppliers, your vendors, your customers, anything and everything can now fall within the purview of associated enterprises. This was not the case before. And therefore, I think you will have to go back to the drawing board and understand how your relationships are structured. So any relationship which was not covered within the realm of associated enterprises could now be covered. And I'm sure Ashwath is going to delve deeper into it and tell us more about it. I think the other important changes are related to safe harbor and the APA regime. Uh, this is more of a policy change. APA, the pricing agreements clearly have been very helpful for the government and for the taxpayers to arrive at a clear pricing and determine it in a way that helps the businesses get certainty in their business. Now, the way the changes have been made to especially the APA regime, it's very clear that they are giving you a timeline, overall timeline of 2 years. And if it's a unilateral APA, and if you have the APA within this time, it's a great success that you find. Again, there are some ifs and buts. There are some conditions that you need to follow. But again, it's a very, very welcome move. As far as safe harbor is concerned, I think it's a boon. It's a fantastic provision that's been offered to especially ITES companies, KPOs. And so they have this block period concept. You can have a safe harbor for 5 years. It gives you a very attractive rate of 15.5%. I think Ashwath will take you through this provision in more detail. And I think something that should be very clearly understood by those of you who are in the ITES, KPO businesses, very, very important change, and how it can help you, how it can completely change the way you look at transfer pricing from both the compliance perspective and the strategy perspective. The final bit of changes, which is again a very, very critical change, is the change to Form 48. And you all know Form 48 today as Form 3CEB. Now, these are changes that are significant from a compliance and governance perspective. Now, if you remember, Form 3CB today is a very high level reporting exercise, right? So you have different sections of reporting, different clauses of reporting. So if there is a reporting that you have to do for a service transaction, it does not differentiate between the nature of services or different agreements that you have. If you're talking about royalties, it does not differentiate between what are the different types of arrangements that you have with your AEs. Now, in the new avatar of Form 3CB, which is Form 48, you will have far more greater obligation to report in more detail. You will have to also state your assumptions as to how did you arrive at the arm's length price. So it's a very relevant change, and I think all of you, since it's a new requirement starting the next year, all of you must try and understand where this is going, where this is heading. Is there an additional complexity that it adds to your business? What is a good timeline when you should start documenting all your transactions? So anything and everything that you do today is going to be reported to a large extent in Form 48. So what we have done is today's discussion is not only to explain what has changed. Certainly, we'll discuss what has changed in the new law, what has changed in safe harbor APA regime in the last budget. But you should, keep your eyes and ears open to understand why these changes have been made, and what is the real impact on you. What is the level of complexity it adds to your business? What is the level of transparency you will require? So I think a lot of questions to answer. And with these opening remarks, Ashwath, I will like to invite you. Maybe you could take us through the definition of the associated enterprise and the APA and the safe harbor regime. What have been the changes? And maybe then we can go to Harshit. Thank you. Over to you, Ashwath.
Sure. Thanks, Sunil, for the opening remarks and for setting the context for today's webinar. Like you mentioned, taking cue from the requirements which have been there in the transfer pricing regime, we'll go first to the associated enterprise definition. So for transfer pricing to apply, there are two key criteria. One is that there has to be a transaction between two parties who are considered as associated enterprise. And second, there has to be an international transaction. So just to give some context, while the Income Tax Act 2025 was being drafted, the government said that the intention of bringing in a new act is to make it more simpler, user-friendly, and to try to take away the interpretation-related issues. Now, under the earlier act, which is of 1961, the associated enterprise definition was defined under section 92A, and it had two subsections. The first subsection dealt with a subjective clause. That is, it said that for an entity to be considered as an associated enterprise, it had to have management, control, or capital in the other entity in India. So this was a subjective clause to ascertain whether one of the entities has some management role or whether they have some control over the board of directors or any other manner of control and whether they have capital invested in the Indian entity. The second subsection had some objective clauses, such as, say, ownership of shares or voting rights about 26%, giving significant loan to the Indian entity, or giving corporate guarantee or such other relations. So there were about 12 subclauses, sort of defined tests, which used to lay down as to when an entity could be considered as an associated enterprise. So generally, there was some interpretational issues where the department felt that if you sort of satisfy either the subjective criteria of management control or capital or the objective criteria, either of them were sufficient for you to be treated as an associated enterprise. But what we saw in litigation, most of the courts favored the interpretation that both subsections have to be satisfied, meaning that you have to have a subjective criteria of management control or capital, and also one of the objective criteria for some enterprise to be considered as an associated enterprise. And this was mostly the understanding which was carried on. But now I think when the new act has come up, intentionally or unintentionally, it looks like a significant change has been done. Whereas you could have a situation between a third party transaction where there is substantial, say, relationship in terms of the transaction, say them being a key raw material supplier or them giving some technology, or maybe they could be a key customer. But they could be a third party relationship, that meaning that they are not within the same group of companies. Even that could be covered now under the associated enterprise definition, thereby getting covered under the transfer pricing regulation. So in the next slide, we'll see how the act has changed now. So like I mentioned earlier, there were two subclauses, subsections, subsection 1 and subsection 2. And subsection 1, you can clearly see, states that management control or capital in the other entity is necessary. And then you go to the deeming fiction under subsection 2, which said that we have certain objective criteria like 26% of voting power or 26% of shareholding or some other objective criteria. Only then, if both were satisfied at the same time, the new act, it has been made more reader friendly from the department. But from an interpretation standpoint, it looks like satisfaction of either, that is management control or capital, which is a very subjective criteria, or one of the objective clauses can lead to an AE relationship. So companies have to be careful now as to whenever they enter into a transaction, whether they could have a AE relationship being set up, which earlier used to be the interpretation that there has to be some management or control over the entity. Now that appears to be not necessary, or the department at least may interpret it to be not necessary. So let us look at certain common examples which we see regularly. So let's say the first example. So you are an Indian company and you procure 95% of your raw materials from a foreign supplier. This is a very common scenario. And generally the foreign supplier will be designated by a foreign company. So say a lot of manufacturing push which is coming into India is leading to captive, say companies or captive manufacturing companies or contract manufacturers who manufacture under certain guidance from the foreign company that they'll procure specific raw materials from the same supplier and manufacture it in a certain manner and then sell it to certain parties. So earlier, unless these raw material supplier had management control or capital in the Indian entity, they would not be considered as a related party or an associated enterprise, and thereby the pricing and other, say, conditions of the transaction would generally not be under the purview of the transfer pricing regulations. But now, because of the change in the AE definition and reading subsection 162 subclause 1 subclause G, which states that if more than 90% of your raw materials are sourced from a single supplier, and that is a foreign company, and that itself could lead to a AE relationship now. The second example is, suppose an Indian company manufactures products exclusively for a foreign company and sells about, say, 80% of your produce to the same foreign company. Earlier, unless the buyer, the foreign company, had some management control or capital in the Indian entity, it would not lead to a AE relationship. Now it seems because of the new definition, it can lead to a AE relationship. So if you have a key customer who, say, procures a lot of your products, or it looks from the outside that he can influence the pricing and other criteria, which generally happens because large, say, orders which are placed in are generally placed in after a discount. So such relationships could also now come under the transfer pricing regulation. So anytime you have a key customer for a manufacturing entity, that relationship has to be now carefully evaluated to see whether it becomes a AE relationship. The third scenario, which is very common, is we see a lot of treasury companies who give loans to the group companies. Now, such treasury companies may not have shareholding in the Indian company, or it could be some other company, say a PEVC venture or a foreign bank, which gives a substantial loan to an Indian company without having any shareholding. Now, generally under the 1962 Act, such relationship, unless there are certain significant terms in the loan agreement, would not be considered as an AE relationship. It would be generally seen from a normal lending relationship. But now, because of the definition change under the new act, because this sort of satisfies one of the objective criteria that substantial loan is being given by a foreign entity to an Indian enterprise, even getting a loan from a foreign company without having shareholding in the Indian entity can lead or could lead to a AE relationship now. So, like these examples which you have seen, common scenarios which generally play out in today's world could lead to a AE relationship. So let us look at a case study, which is also a very common fact pattern, that you have a common director. In this scenario, there is one Mr. GK, who is a director and is a shareholder in the Indian company. And he also happens to be a director in the Singapore company, but he has no shareholding in the Singapore company. Now, this is a real life scenario where the department argued that because this individual had management rights in both the companies, any transaction between these two companies would be considered as a transaction between associated enterprise and hence would be under the transfer pricing lens. However, the tribunal, the Mumbai tribunal in this case, ruled that since Mr. GK did not have any shareholding in the Singapore company nor satisfied any of the other objective criteria, this would not lead to an AE relationship and this would be a normal transaction, because for the AE relationship to come in, Mr. GK had to have some shareholding about 26% in the Singapore company as well. So because this criteria was not satisfied, earlier under the 1962 Act, such a fact pattern would not be considered as an associated enterprise transaction. But because under the new act, there is no requirement that both the subjective and objective criteria have to be satisfied at the same time, this could lead to a AE relationship. So any companies who have common shareholding across various companies, and if the common director has some amount of influence on both the companies, they have to very carefully evaluate such fact patterns, even though the common shareholder or the common director may not have shareholding in both the companies. The department may now start arguing that such relationship could also come under the associated enterprise or related party transaction ambit. Next slide, please. So this is also a real life scenario, but a pretty common scenario. So we had an Indian company specifically set up to cater to a US company, and they used to manufacture nozzle shroud plates, and this Indian company had been specifically set up only to cater to the US company's demand. And almost 100% of its manufacturing and then its products were sold to the US company. And the US company did not have any shareholding or management or control rights over this Indian company. It was a normal trading relationship which was there, but 100% of the products were sold to this single company. Now, under this fact pattern, the department argued that this is a AE relationship because the US company has significant influence over the products of the Indian entity. So basically, they can determine the pricing and other relationships. But when the taxpayer went before the tribunal, he got a successful ruling by stating that because there was no shareholding, management, or control of the US company over the Indian company, and since the earlier interpretation was that both the subjective and objective criteria had to be satisfied, this would not lead to a AE relationship. So under the earlier act, such relationships could have been argued that they do not lead to an AE relationship. Of course, subject to evaluation that pricing and certain other key conditions are not influenced by the other enterprise. As long as management control or capital did not exist in the Indian entity, it could be fairly argued that they do not lead to a AE relationship. But now under the new act, because the condition doesn't have to be satisfied, that is both the conditions do not have to be satisfied at the same time, this could lead to a AE relationship. So contract manufacturing or say specific manufacturing for the same customer, if there are such relationships being planned or already existing, I think they will have to be carefully evaluated now as to whether they lead to a relationship, and if yes, whether the prices which are being charged are as per the arm's length criteria. Next slide, please. So clearly, the AE definition expansion has to be carefully evaluated now, and it cannot be just a one-time exercise where you sort of evaluate it right at the beginning of the relationship and then do not relook at it. The moment there is any change in the pricing or any other, say, important factor to the transaction, it has to be continuously evaluated now whether the transaction can lead to a relationship. And I think going forward, businesses have to first sort of evaluate and assess whether a restructuring or a specific arrangement could itself create a AE relationship. So like we mentioned, specific manufacturing, a single raw material supplier, or say dependence over IP or any other say relationship like that could lead to an AE relationship. So I think it has to be critically evaluated now, and it cannot just be a first time exercise which companies used to do. Uh, Even in the existing relationships, because there was earlier certain favorable rulings, a lot of the parties would think that their transaction would not be covered as an associated enterprise transaction. Now, after the new act coming into play, they have to maybe relook and evaluate as to whether the past transactions also can lead to a relationship now. And if yes, how do they report such transactions in Form 48 going forward? So what can companies do? First of all, you should ideally have a TP health check and risk review regularly to see that if there are any change in the pricing or commercial criteria or commercial relationship, whether they can lead to a relationship. Pre-structuring evaluation. So because we see a lot of free trade agreements also coming in, it is expected that a lot of trading relationships will be starting, especially in the manufacturing sector. So prior to entering into any of the relationships, it has to be evaluated whether such relationships can lead to a relationship, even though seemingly between third parties who are not part of the same group. Careful review of intercompany agreement. Earlier, because there was protection under certain guidances and under certain judicial precedents, a lot of intercompany agreements would not be designed in a manner in which they should have been designed. So they may have to be renegotiated or re-looked into. And stronger documentation has to be maintained, first of all, to justify whether the AE relationship exists or not, and secondly, to sort of showcase, even if they exist, how it is being supported through benchmarking, which is done regularly. So overall, the focus is expected now to shift to a more proactive and strategic TP approach rather than just being looked at a one-time exercise or just being looked at or relying upon various other judicial precedents which used to support the view that AE relationship does not automatically trigger in certain conditions. Next slide, please. So these were the discussions relating to the AE relationship. Like we have seen, a small change in the manner of drafting has related to a wide expansion of the AE relationship now under the transfer pricing regulations. While this may not be seen as very favorable to the taxpayers, on the other side, we have seen that the government in its budget announcement, specifically to cater to the IT sector, which was expected to be doing already very well, and with the advent of GCCs coming into India, one of the criteria or one of the key pain points used to be the amount of litigation which the IT companies had to go through, especially on the margins which were being expected. Even in our practical experience, we had seen that whenever there was scrutiny assessments going on, the margin expectations of the department would be significantly on the higher side. And companies sometimes would go through protracted litigation where on an annual basis they would have to go through this exercise and where the margins would be expected to be on a higher side. And safe harbor was already there, but it was not getting the kind of response which the government was expecting. Primarily because the threshold was pretty low. It was 200 crores, which was then enhanced to 300 crores. And there were the margin expectation also was on the higher side. So I think to address these pain points, the government in the recent budget had made certain significant changes to the safe harbor and the advanced pricing agreement or the APA for IT companies. Next slide, please. So what are the changes in the safe harbor regime? So earlier there used to be classification of the companies into IT software developers, ITES providers, KPO providers, and contract R&D providers. So there used to be various categorization of the seemingly similar companies, or we had seen in certain cases companies would provide various services. So for example, they would provide software development as well as ITES services. So these would be classified differently, and each of them had its own criteria, own turnover threshold, and the margins would also vary depending upon the kind of classification. So for example, say you are a common ITES supplier, your margin could be cost plus 17%, the expected margin. Whereas if you were classified as a KPO, the margin could go as high as 24%. So this used to lead to a lot of confusion and litigation, and hence maybe companies were not so keen to apply to the safe harbor as an option. Now, what has been done is for all these four various categorizations, they have been now clubbed into information technology services, a single criteria whereby the different margins which used to apply, that is 17 to 24%, has now been clubbed into a single margin of cost plus 15.5%. So thereby the margin classification which used to say exist earlier will not be required going forward. The second thing is, like I mentioned, turnover threshold. So a lot of GCCs who have, say, dollar billing, they would quickly, say, raise up to the billing level of 300 crores or more. And hence, the only option for them to maybe get some protection on litigation would be to go for an APA, which would be a longer process and at times even more expensive. So now the turnover threshold has been sort of increased from 300 crores or 3000 million to 2000 crores or say 20,000 million rupees, which is a significant change. It's almost a 7-time increase in the turnover threshold, which is expected to bring in a lot more companies, or at least a lot more companies can now evaluate safe harbor as a good option. The third major change is the block period concept. So earlier, if you had to go for safe harbor, you would have to annually apply. So this used to one lead to uncertainty because any year the officer could challenge the safe harbor option and say that for this year I sort of do not approve the safe harbor option. And the second thing would be the margins could vary. So every year we would wait in the budget that if there is a change in the margin or whether the previously announced safe harbor margin would still continue. So it used to be an annual exercise. Now what has been done is they have stated that once your safe harbor application is approved, you could continue in the same safe harbor regime for 5 years. And in fact, even on the turnover threshold, they've said that the turnover criteria would be evaluated only in the first year. So in the first year, if your turnover is below 2000 crores and say over the period of say 5 years, even if it increases, you would still be eligible for a safe harbor option. So this provides a key clarity and certainty for those whose safe harbor applications are approved. There are certain other criteria which are mostly unchanged. So for example, uh, so, so for example, the requirement is that you have to be a low risk captive entity to opt for safe harbor regime, meaning that the expectation is that you will not undertake significant risk. The conceptualization, design of the working of the say software or any other classification would be done by the associated enterprise. There would not be any IP development in India, and all the funding and other requirements would be provided by the foreign entity. So basically, only the execution would be done in India, and the other things such as design, conceptualization, sort of IP capitalization would be done by the foreign entity. The next thing is, like I mentioned, it's a 5-year block period concept. But if you have to withdraw from the guidelines, it looks like only within the second year you can withdraw from the safe harbor option. Otherwise, there is no specific sort of criteria in the guidelines which allows for withdrawal. So I think a careful evaluation has to be done prior to entering into the safe harbor option. And there used to be manual filing earlier, so you had to file manually each year the forms. Now it has been made electronic, and earlier you had to go to the local transfer pricing officer. Now that has been shifted to a single window system, whereby DGIT systems will evaluate the application and then approve it. So these are some of the key changes in the safe harbor regime for IT companies. So the advanced pricing agreement also, like we had alluded earlier, there has been a significant change. So while companies used to go for APA, this used to be mostly in the cases where companies were facing a lot of litigation and they would want to have certainty and clarity. So therefore they would go for the APA option. But thereby what would happen is on an average, a unilateral APA would take anywhere between 3 to 4 years and a bilateral would take over 5 years. So while companies wanted say some relief from litigation or certain certainty, it would take a very long period of time. And this would lead to a lot of uncertainty for, say, additional investment or additional functions being taken over in India. Because once the foreign company or the foreign parent, if you would feel that in India adding functions would lead to more litigations, they would hesitate prior to getting certainty through the APA framework. So possibly to address this time lag which is there for from the APA application being filed till they get approved, now it has been announced in the budget that, and even in the guidelines now it reflects in the rules as well, that unilateral APA applications for IT companies would be approved within 2 years from the end of the quarter in which the application was made. And if the taxpayer wants additional time, he could apply for an additional time of 6 months for the APA application to be concluded. So I think for those who are looking at certainty through the APA application process, this is a welcome change, because earlier what would take 3 to 4 years on a minimum now has been reduced to a 2 year time frame. And it is a assurance from the department side that they will try to complete these applications within a 2 year time frame unless the taxpayer wants some more time. So this is a welcome change which has come in for APA applicants from the IT sector. Next change, please. So let us look at a comparison. So in our discussions, what we saw is companies who wanted certainty were earlier looking for APA as an option, but now due to the changes which we discussed earlier, even Safe Harbor now could become a key option to be evaluated, or something which companies may want to relook at. So we have just given a brief sort of comparison for companies who are evaluating or actively looking at both the options as to what could be the criteria. So Safe Harbor, there is a upper turnover threshold that only companies having turnover below 2,000 crores in the first year of application, they can apply. Whereas under the APA regime, there is no upper turnover threshold limit. So those who are maybe exceeding the turnover threshold of 2,000 crores, for them only APA is an option in terms of litigation certainty. Operating margin expectation. So clearly there is an expectation that the operating margin for IT companies has to be 15.5% or more. Whereas under the APA, it's a negotiation process. So it's a case specific negotiation process. So if you can convince the authorities that basis your specific facts, that you do not have to say provide margins of more than 15.5% in India, then that can be done. What we have seen is it's slightly difficult for companies to get especially IT companies to get margins below 15.5%. But if the facts merit such a lower margin, it can be done through the APA process. FAR analysis is the most critical sort of criteria which separates those who can apply for Safe Harbor or whether they should apply for an APA. Like I mentioned earlier, Safe Harbor is generally meant for those companies who have a routine or captive model, who do not undertake risk in India, do not have significant IP ownership, and conceptualization, design, supervision is all taken care by the foreign company. So if you are such a company, then obviously Safe Harbor is a very good option now. But if you have an entrepreneurial profile, especially GCCs and innovation centers who undertake a lot of significant risk or significant functions, they try to take up IP ownership, or even in some cases they have leadership sitting out of India. So for such companies, a Safe Harbor application may not be approved. So for them, the APA could be an option to be actively looked at. What is the cost? So this is also key criteria in our discussions which has come up. So APA obviously has a minimum fee of 2 million Indian rupees, which has to be deposited prior to the application being filed. And adding consulting cost, it could easily be a few million rupees for the APA application. Whereas Safe Harbor, there is no standard fee which has been prescribed as of now. So those who may be looking at both and those who can satisfy both in terms of their FAR profile, Safe Harbor in terms of cost could be relatively less. Next slide, please. So what we have done is we have taken certain case studies or examples for somebody to evaluate between Safe Harbor on an APA. So the example here which we are taking is that there is an Indian company which is a captive service provider, and it provides IT support services such as help desk support service and application maintenance service. As of now, they are earning a margin of cost plus 12%, and they are expecting that in this year their turnover is likely to touch 350 crore rupees. And the issue between for the Indian company is whether they should go for APA or a Safe Harbor. Next slide, please. So from a prima facie perspective, I think this company is a good candidate for safe harbor application, considering the turnover and the margins which it is currently charging. But obviously, for it to apply for the safe harbor margin, it will have to enhance its margin from 12% to 15.5% or more. But the key criteria is the FIR analysis that has to be critically done to evaluate what kind of functions it is undertaking. While on the outside, a lot of companies captive service providers, they are back office, and they do not have critical functions. It has to be necessarily evaluated because this will be, in our expectation, the application will be carefully evaluated before they approve the safe harbor application. And any such change, for example, say you have some leadership role in India, or someone who is part of conceptualization or design of the IP in India, or they feel that there is some risk which is being tried to be taken from India, or adding third party customers, or any other such key criteria which leads to the FAR analysis not being satisfied in the case of a safe harbor evaluation, may not lead to the application being accepted by the authority. So while from a prima facie perspective, yes, such companies do look a good candidate for safe harbor, but obviously they have to critically look at FAR analysis before they apply for it. So in this scenario, suppose their safe harbor application does not get approved, or if the company states that they find this 15.5% margin to be higher, the only other option for them to be evaluated could be the APA option, because there is no threshold limit and there is no prescribed margin. Like I mentioned, it is a negotiation process. So if they feel that they can basis their functions, which are looking like low end functions, if they feel that 12% is the industry standard which they can justify before the APA authorities, APA could be something which they can look at. The business should be evaluated again prior to the APA application being filed. The industry analysis has to be done to determine whether they will sort of satisfy the APA criteria. And like I mentioned, there is a 2 million rupee fee as well. So I think companies will carefully evaluate before they go for a APA application. In some cases, we have also seen that PE risk, which used to exist for companies, say you would have some foreign company employee sitting out of India and doing some business, or leading the design, or doing some other function, which at times could lead to a PE risk. A lot of companies are using APA as an option because there's a detailed discussion and the attribution is also discussed prior to the APA being approved. So in some cases, companies who face significant PE risk could also evaluate APA as an option. And APA, as we have seen in our experience as well, once it is approved, it generally helps in mitigating the litigation risk unless there is a change in function. Next slide, please. Another example is of a company which is engaged in software development and certain other support services. Currently, they are at a cost plus 16.5% margin. This is also a captive service provider, and they are also expecting a turnover of around 350 crores to 400 crores this year. The company is already under the APA regime. So earlier they had applied for APA, which had been accepted, but now they are in the last 2 years of validity. And now the company is thinking, considering the cost and other, say, benefits which they may get under APA or the compliances which they have to undergo, whether they should look at safe harbor as an option. Next slide, please. So safe harbor, again, from a prima facie perspective, they look like whether they will be a good candidate purely from the margin expectation as well as turnover. Both of these criteria they do satisfy. In fact, their margin from 16.5% could come down to 15.5% as well if their FAR analysis is satisfying the safe harbor criteria. So obviously, for those who are under the APA regime, and if they're looking at safe harbor as an option, again, the evaluation has to be done and they may have to relook at their APA application renewal as well. If going forward, if they feel that safe harbor now, because of the additional threshold and the lower margins, whether safe harbor could be an option instead of APA. So like I mentioned, the increase in the turnover threshold again helps, and companies who are already above 15.5% as margin, or whose APA applications were negotiated at a higher margin, they could maybe now relook at safe harbor as an option. But carefully they have to evaluate. And another interesting part was that there is no specific option which has been given to companies which are already under the APA regime as to whether they can automatically shift to the safe harbor option. So they may have to relook at their validity and then take a call. or they may have to just wait out their APA period and then maybe come under the safe harbor regime. This is something which has to be carefully evaluated. Like Sunil had earlier mentioned, Form 48 has been completely revamped. Earlier, what used to be Form 3CEB is now Form 48, and a lot of additional disclosure requirements and transparency requirements are expected. And this has become more voluntary now. So, what used to happen during the scrutiny proceedings or would be revealed or discussed only during the scrutiny proceedings may now have to be voluntarily presented in the Form 48 itself. So to take us through the nuances of the changes in Form 48, I sort of request my colleague Harshit to take over.
Thank you, Ashwath. And thanks for the kind of detailed walkthrough on the AE definition, the changes which were made, and also to the safe harbor versus the APA evaluation. With that, and as Ashwath said, we will now move towards the final substantive segment of the amendments which are being brought to the Form 48. To start with, for those who have been filing Form 3CB over the years, you would know that this has largely remained the same or unchanged for more than over a decade. It was essentially a kind of narrative or a summary level form which was there, that is this Form 3CB, wherein we would disclose the nature of the transactions, the aggregate value, the method adapted, the arm's length price, etc. And that's what is. The real analysis, though, was kind of documented in the TP study, which was presented before the assessing officer only during the course of an assessment or when the need arises. With that, the Form 48 changes this entirely, and it's kind of a significant overhaul of the India's transfer pricing reporting documentations and framework. And it is designed specifically to kind of enable the data-driven risk assessment by the tax authorities. One second, my slides are not. Yeah. The first major change which you see is around the transaction level reporting, which is required in this new Form 48. Earlier, you could group the transactions and report them as a broad summary under a clause entries. Now, every single international transactions, deemed international transactions, and specified domestic transactions must be reported as a separate line item with a unique identification, system-generated identification of the transaction ID which has been given. There are multiple predefined transactions categories, and especially for the IT companies as well, there are subcategories which are being specified, such as software development, ITAS, KPOs, contract R&D, which needs to be separately kind of reported, with each having its own unique system-generated transaction ID. Say that if you are providing 3 types of services to say 2 AEs, that is potentially 6 separate entries, each has to be reported and documented separately. The another change which you see is around the AE identifications and the APA cross-referencing details, which is supposed to be given in the Form 48. So there are enhanced transactions and the AE identification processes through the unique transaction ID, as I said, to enable you to kind of do a cross-referencing and walkthrough. And if you hold an APA, there is an entirely new requirement which needs to be populated in the form, that is the APA date or the acknowledgement number of the APA, and the every transactions must be explicitly mapped to the relevant transactions ID in the Form 48 for which APA is covered. This is essentially a kind of reconciliation exercise that did not used to exist earlier in the old Form 3CEB. So the bottom line, what you see here is quite simple. The era of the summary reporting is now over. You need to kind of restructure your books and the internal tracking mechanism in such a way, and that too from the start of the year, to ensure the clean transaction level data capturing. Moving further, in terms of what I would say is, this is where the compliance burden kind of truly intensifies. Under the old form, what we used to disclose is the method and the final arm's length price. The benchmarking analysis, the comparables, the margins, the adjustments which we used to do. all that used to be followed or kind of were documented in the TP study or the TP documentation. The Form 48 fundamentally changes this. The full arm's length price computation now needs to be forming part of the form itself. You must disclose all the profit level indicators, the number of comparable companies in your final sets, and the complete arm's length price range, and the arithmetic mean also. Further, if you have kind of applied any kind of economic adjustments, be it working capital, capacity utilization, risk, etc., you must consider its natures and financial impact as well in the form. Essentially, what this means practically for the businesses is that the transfer pricing officer kind of even before issuing any notice can now see your benchmarking study, which is right there in the face of the form which you have filed. Your comparable selections are there with the transfer pricing officer, your margin positioning, your adjustments, all are available upfront. This is kind of a substantial increase in reporting and transparency requirement which is there. The second change which you see in this slide is around the intercompany agreements and the financial terms. For the royalty arrangements, you must state the rate, the date of the agreements, and the basis of computation for the royalty. For the financing transactions like ECB, the intercompany loans, the interest rate, the benchmark rate, the tenure, or the categories of loans and the security must be disclosed. The guarantee commissions must also be stated in the form itself. And for the business restructuring terms, there is a categorical requirement of laying down the terms of restructuring in the form itself. Any inconsistency which is between your agreement, what your agreement says, and how the transactions is being actually priced will now be visible by virtue of the changes which is highlighted in this Form 48. Thirdly, there is a change with respect to aggregation versus segregation reporting, whether you have aggregated the closely linked transactions or benchmark them separately. This approach now needs to be disclosed in the form itself. Also, for the multi-segment entities, segmental profit is mandatory required to be reported in the form. This basis this changes, the action point is kind of clear and very straightforward that all the benchmarking, say including for the royalties, for the ECB rates, for the interest, for the guarantees, must now be finalized well before the due date of filing the form 48. Your contracts, your invoices, your transfer pricing records must be kind of internally consistent. And if you are a multi-segment entity, you need to evaluate whether your aggregation approach is defensible before the authorities as well. Another critical change which you see in this slide currently is with respect to the cost disclosures and the revenue items to be reported. This slide deals with what I consider the highest impact areas for the MNCs having subsidiaries operating in India. There are basically two categories of disclosures which are new, which are required to be reported in this Form 48. The first one being the expense or the cost category disclosure. The Form 48 now requires you to specifically disclose costs which are borne by the overseas affiliates on behalf of the Indian entity. This includes stock compensations, your ESOPs, your RSU granted by the parent companies to the employees of the Indian subsidiary. It also includes the cost which is incurred by the AE towards the traveling expense, towards training, towards secondment employees, and towards other employee-related expenses which are borne by the parent on behalf of the Indian entity. And it further also includes the cost or the depreciation of the assets, the software, the tools, the licenses, and the databases which are provided by the AEs. The critical point here is not just the disclosure itself which is required in this new form, but it is also that you must confirm whether these costs are recorded in your books of accounts or not, and whether they are included or excluded from the computations of the ALP. Specifically for the cost plus entities, this directly impacts the cost based. If the parent is bearing the cost that is benefiting the Indian group entities, but these are not reflected in your cost base. This could be, say, free of services, and these are not included in your cost base, then the tax authorities will now see this gap upfront in the form itself. The second category of disclosure which is required in this new form is the revenue category disclosures. So what it states is that income from forex fluctuations, from export subsidies, from duty drawbacks, and from the government incentive must be separately disclosed uh, uh, with the confirmation as to whether they are included or excluded in the ALP computation. What is important to understand here is that going forward, it will be very critical to review all your affiliates cost sharing arrangement, your free of cost arrangements, which are there with the associated enterprises. Ensure that the benefit tests are being satisfied. If at all there are any shareholder related activities, that needs to be documented and categorized very clearly. And specifically for the cost plus entities, it is very important to validate the cost base is documented correctly and it reflects the economic reality which is there. This slide, so let me kind of close my segment with 5 critical takeaways which you see in these slides currently. The first one, as we discussed, this is the earlier summary reporting is now over. It is no longer there. The Form 48 kind of moves from a clause-wise summaries to a transaction-by-transaction reporting with embedded benchmarking study in the form itself. The transfer pricing findings are now directly visible on the face of the form. This is not just a compliance change, it is a dynamic of how the assessments will be conducted going forward. The second is the tightening of the intercompany agreements. This is something which Ashwath also mentioned in his change when he was discussing the changes to the AE's definitions and all. The financial terms of the royalties, the financing, the guarantees, and the restructuring arrangements are now supposed to be disclosed in the new Form 48. So any inconsistency between what the agreement states and what the invoices shows and how the transfer pricing document supports, that will be flagged and scrutinized in a very, very close manner. The third point or the third key takeaway being the details with respect to ESOPs, reimbursements, and the cost base could be potentially be a high scrutiny areas. Specific disclosures are now mandated for ESOPs, cross charges, cost allocation, free of cost services, and the secondment related aspects. Cost plus entities must kind of substantiate the full cost base. This potentially is the area where a large number of MNCs operating in India will feel or will see the impact. The fourth one being the aggregation approach must be justified upfront, whether you are aggregating or segregating for the benchmarking purposes. This needs to be disclosed for the multi-segment entities. They need to report and disclose the segmental profitability with the documentation support as well. The last, and again similar to what Ashwath kind of mentioned during his slides, it is better to be proactive. Invest. There is a need of the hour to kind of invest in the transfer pricing health check. The TP compliances is no longer a kind of an year-end exercise with the automated risk profilings which are used by the authorities and the real-time data visibility which is there with the authorities. Any inconsistency between the Form 48, between the TP study and between your intercompany agreements and the financial statement is likely to be flagged. The compliance infrastructure needs upgrading here, and there is a upfront requirement of doing a benchmarking, transfer pricing health check, FAR reviews, and documentation strengthening should become very, very relevant. So with that, I would like to invite Sunil to kind of come here and give a closing remark, and then we can keep the floor open for the questions, please.
Thank you, Arshad. Thank you, Ashwath. I think wonderful talk on the changes that have happened. I just have a couple of questions. Some of these are audience questions, some of these are my own questions. Ashwath, first one to you, because I wanted to get a clear understanding of where this is going. When you talk about safe harbor, Ashwath, we've been seeing in the recent past, there are a lot of companies that will launch under the GCC structure. A lot of companies will launch their innovation center or development center in India. Now, traditionally, there has always been an understanding that these centers, by whatever name called, they will not be adding significant value. But given that today we have a specific definition and criteria for the safe harbor eligibility, how would an innovation center be looked at from a safe harbor eligibility perspective? Because the way I understand an innovation center is not necessarily a center that adds value that acts as a back office service provider or a support service provider, but an innovation center is something that supplies or assists in development of new technologies for the entire global operations of a conglomerate. So how would safe harbor work in that particular environment where the requirement is that there should be insignificant risk added by the Indian company? Any views?
Yeah, so I think there are certain sort of very clear guidelines as to who can apply for a safe harbor, and there are multiple sort of criteria which are laid down. First is the conceptualization, like how the conceptualization happens, the supervision. So there should be supervision from an overseas entity. In terms of IP development, funding, all of that should come from the foreign entity itself. And I think earlier as well and now under the revised rules which have been released, the expectation seems to be that safe harbor is more towards execution prone entities who more look at execution rather than developing some say IP or taking significant risk on their own, because these innovation centers generally will have a mandate that they should come up with something which is maybe not existing or has to improvise on something which already exists. So thereby there will be some element of risk which are unfortunately our guidelines now do not want the Indian entities to take up. They are more looking at execution based entities who either do not take part on the IP development or some other functions, and if they do, their sort of involvement is very limited. So with innovation centers, I think we are also seeing a lot of news reports that leadership is also shifting to India. Indian employees also get leadership roles where they take over certain functions and deliver on them. So I think safe harbor currently from the guidelines, obviously subject to evaluation, innovation centers may not be necessarily in the ambit. For them, I guess still the APA makes more sense.
Makes more sense. But again, it all depends on the real conduct of the Indian entity. They might call themselves innovation centers, but all what they may be doing could be easily seen or characterized as back office services, more execution centers.
Right? Nomenclature, because a lot of them still call themselves as back office, where they actually could be innovation centers. And somebody just to give a larger role to themselves, they may call themselves as innovation centers where they may not be. So obviously, FAR analysis will be the key critical component, irrespective of the nomenclature which they give themselves.
So a low risk service provider,
low risk execution
essentially has to be established. One more question on safe harbor, Ashwath. I'll just hold you just for a minute. Now, I think this is an audience question which says that if the TPO has accepted a margin of 12% in the past years, is there still a need for an APA?
This depends, because generally in our expectation, IT related or say ITS providers, it's very difficult to get a 12% margin. And annually they do expect the benchmarking to happen to reflect the current results. So it depends on how say soon the assessment has happened. So if it's a immediate past year, yes, you could rely on that. And now we also have the block assessment concept where you could extend the assessment for 2 more years. So yes, if in that example, if you assume that the TPO was okay with a 12% margin, you could extend it. But in our expectation, 12% is a little difficult to get. And with the transfer of officers, you always have a new officer who will view it maybe differently than what the erstwhile officer had. So this is something which has to be evaluated, particularly for those looking at certainty, because the foreign enterprises would not want annually themselves to be looked at from a margin perspective.
I agree. I think, and I can vouch it with my personal experience, 12% has never been, it has been accepted in some cases, but certainly not sustainable in the long run, given that the government now today accepts a 15.5%. Again, if anybody has had a specific arrangement, they've been able to demonstrate if these services are real or ultra low value added services. I think in that case, perhaps 12% would have been okay in the past. One last question, sorry, Ashwath, on the safe harbor, since we are on the subject of safe harbor. One second. This is again an audience question which says, is safe harbor applicable to companies having headquarters in Singapore, but the Indian entities undertake two responsibilities: the task of developing the product based on the instructions from the headquarters and have domestic sales in the country? I think the first one you've already answered. If they are developing based on the instructions from the headquarters, this is more or less a support in terms of execution. But the second limb of the question says, safe harbor, would it apply if there are domestic sales in the country? To my understanding, I don't think domestic sales will have an impact as long as it's being done independently and where the local entity does not have a role to play. Is that correct understanding?
Yeah, I think through segmentation, they can still go for safe harbor. They'll have to do segmental reporting and sort of bifurcate their domestic sales and the, say, captive service provide what they provide. And then through the FIR analysis, they can clearly show that. I think some of the times what happens is some companies fear the moment they have domestic sales that low risk criteria gets taken away from them. But as long as, say, it's not significant or it doesn't result in a scenario where you can't do segmental analysis, you can still apply for safe harbor on the segmented portion, which is the captive service provider. Another thing is, one thing which they have still continued is that your AE should not be from a low tax jurisdiction. That's there in the safe harbor guidelines. So Singapore, as long as it is not classified as a low tax jurisdiction, I think it shouldn't be an issue from a safe harbor perspective.
Understood. I think this kind of covers everything. Harshit, one question for you. And this is a specific question on disclosure requirements for intercompany service agreements. And I think you did touch upon that. I also did touch upon that. But the question is, what kind of details need to be disclosed in Form 48 with respect to intercompany service agreements? Can you just give us some pointers there? Specific details.
So, Sunil, in terms of the disclosures which are required for the intercompany service agreements, firstly, if it is in relation to services, you need to mention the date of the agreements which is there, the nature of the services which are there, which is provided. The benchmarking approach needs to be very clearly documented, which earlier we used to be forming part of the transfer pricing study, and the details with respect to the arm's length computation, again, the details of comparables and all that stuff.
So everything must be disclosed in Form 48 today?
Yes.
Right.
The Form 48, besides what we discussed, being a transaction level reporting as against the broader service level disclosures, has now required to be reported with the embedded benchmarking for each and every transaction which we are reporting in the Form 48.
Understood. Harshit, if I was to ask you a question, what is one most significant change in Form 48 that you would like our audiences, businesses to sort of take back home? One heavy duty, significant change in the Form 48 reporting, which again, if there are Indian subsidiaries of foreign companies, they must take it back to their headquarters. Anything that's really significant?
The most significant, according to me, is with respect to the cost disclosures which are required to be made. Specifically with respect to the ESOP cross charges, the reimbursements, the cost-based computations for the cost-plus entities of the foreign companies which are operating in India. That is something which is very critical, especially in the cases where costs were kind of borne by the foreign companies but not recharged to the Indian cost-plus entities, just to ensure that the cost base is not kind of inflated and again charge it back to the parent. In those scenarios, there is a specific question which says that you need to very categorically mention what is the amount which is recorded in the book and the amount which is not recorded in the books. Okay, so those kind of questions will give a ready kind of a flag and the opportunity for the transfer pricing officers to kind of raise a issue and scrutinize this further.
So this was something which the tax officers used to discover at a later stage at the time of scrutiny. But today they will have to make no effort because it will already be disclosed. So they are directly trying to hit the cost base. So if the cost base today is 100 and there are unrecorded costs of 10, tomorrow the cost base will automatically go up from 100 to 110, right? That is what you're trying to say. Ashwath, anything on Form 48 disclosure, because this is very critical and we want our audiences to sort of take back home a very clear understanding there.
Yeah, I think like Harshit mentioned, the cost-related disclosures, and I think those who are following aggregation approach, a lot of times you would see the TNMM aggregation approach, where a lot of smaller transactions like royalty or say interest payments or some other key transactions would be justified under the entity level margins. So now the expectation is that under the aggregation approach as well, you will have to list all the separate transactions and justify whether you have benchmarked them or not. So in our example, where we would see a lot of royalty transactions or say brand fee or some advertisement help, these would not be separately benchmarked, assuming that the entity had enough profits at the P&L sort of net profit level. So now they may have to be separately benchmarked, and first step would be disclosing them. A lot of companies may not have even disclosed this transaction. So they will have to disclose it, and a precursor to the disclosure, they have to be benchmarked. So as to whatever disclosure happens, you can justify the same.
Understood. I think makes a lot of sense. Okay, I think we already have run out of our time and there are no more questions from the audience. So maybe I can just give you a broader understanding of what we discussed. So I think Ashwath, the explanation that you gave in terms of the expansion of the associated enterprises definition, I think that is a very fundamental change. I started reading the law of transfer pricing in 2001, and this was the first presentation that I did at a larger forum where I did extensively spoke about the AE relationships. And one part was the deemed relationships. And there was always a precursor to it that any relationship, does not count unless there is exercise of control and management. And I think the point that you made about the absence of this or elimination of this particular aspect in defining the associated enterprise relationship, I think is a very critical aspect. So my suggestion to businesses will be to go back on the drawing board, try to see, evaluate all your relationships, anything that you were keeping out due to technicalities, anything that was kept out because it did not meet all the criteria. I think now it's a fight out in the open. So you will have to review, revisit, reevaluate every transaction, every relationship that has happened. So today, the first question you're asking is, is this a related party transaction or not? So you go back to the most fundamental question. So I think very important aspect. The second point that you made about, I think, Safe Harbor and APA, and I understand it's not a very clear choice for businesses. Safe Harbor is very case specific, industry specific. And I think for a lot of our clients, Safe Harbor can be applicable. A lot of audience at large in terms of those who are from the IT, ITES, KPO segment, Safe Harbor is something that could be applied. APA, I think, is a wonderful move by the government. The 2-year timeline is a boon and certainly something that the companies must explore. The question where we had a scenario where the company already had a 12%, I think for them also APA may be a better option if they were to reiterate their margins of 12%, and if this has been certified by the tax or TPOs once in India, once, twice, whatever, I think it may be a good option for them to go back and try their luck on the APA side. And now you can get a decision in 2 years. So I think certainly very useful. One additional point that you made, that APA today is being used as a broader risk management strategy, where if you have a permanent establishment exposure, it is generally considered very useful to go to the APA route and get a determination where indirectly what you determine is you try to ring fence or you put an upper cap to the profit attribution of the permanent establishment. So I think very, very valid point. And I think for businesses, the key question is that whether these developments create an opportunity to achieve greater certainty. And if yes, that is something that you should certainly try and evaluate, examine very closely. On the Form 48, I think changes, the way I see it, certainly for the initial years, more complexity, because we are today not used to of disclosing details to this extent. I think most of the generally the rollover exercises are done at the end of the year. Certainly not recommended in the new scenario, in the new landscape that we have, framework that we have. So Today, I think businesses, as they move towards more precise reporting in Form 48, there has to be very clear consistency in the intercompany agreements. The actual conduct in accordance with those intercompany agreements, your invoicing, your transfer pricing documentation, anything and everything that you have in the related party documentation landscape has to talk to each other. Today, you can't afford to have completely alienated structures on both sides. I think where we expect more complexity is payments like royalties, financing arrangements, guarantees, ESOPs. Harshit, you mentioned about ESOP, cost allocation. Ashwat, you mentioned about cost base. I think very important part. Secondments. I think costs that are booked, costs that are not booked. I think anything and everything will get more attention now, given the extensive reporting that we have to do. So I think we can close this session, conclude the session. We have already run out of time, 10 minutes beyond our time now already. So I think very, very useful discussion. Thank you to both my speakers. Thank you to the audience. And I think we will continue to do these sessions, primarily focusing very specific areas, either on transfer pricing or international taxation, something that adds immediate value to the audience in terms of either reporting or risk management strategy. So thank you, everyone, and have a good evening today. And thank you. We can close the session now. Thanks.
Thank you.
Thank you. Bye.